All right. Fantastic. Well, good evening and welcome to yet another Smartkarma weekly forum. As is customary, I'm going to give attendees a few seconds to start streaming in. And while that's happening, I'm going to run us through our disclaimer. So the weekly forums are strictly for our subscribers. They're meant purely for informational purposes. They do not constitute investment advice. They reflect the opinion of Smartkarma's inside providers and not of us as the platform. And lastly, but importantly, Chatham House rule applies. So please do not share any of this material on social media or any other public forum without express permission. Also, like we've done in recent weeks, we spend about a minute or so looking at what we discussed at some of the more recent forums. And the reason we do that is twofold. First, just to give you a sense of the depth and breadth, the variety of ideas that are showcased, but also to give you a sense of how each of these forums is structured into three sections. A small mid-cap idea, a larger cap idea, and then typically a theme that we're interested in. So last week, for instance, we took a deep dive at a fairly complex idea, which was TBB 511 Hong Kong. It's a company that's seen better days, much better days before, and has really, really struggled recently. And we took a look at how some of the ownership structures are evolving and how this could potentially be a privatization play. We then took a step out and examined the broader issues that are prevailing in Hong Kong at the moment. And very specifically, we looked at a phrase called eminent domain, where basically the government can exercise its authority and take control over private land. And we discussed why that might be an issue that resurfaces imminently within that jurisdiction. And in our large cap section, we looked at Toshiba, we looked at the management buyout and how that's evolving. And we also took a very brief look at how the press uses Smartkarma. The week prior to that, we were focusing on Siloam Hospital, which is one of Indonesia's largest hospital chains. But it's a name that has chronically done poorly, and the stock has traded at very low valuation relative to peers. And we were discussing how Angus feels that's going to change dramatically. And actually, the stock's up more than 20% in just that week and a half, perhaps even more. We looked at Grab and its upcoming IPO strokes SPAC listing. And we also took a look at some of the ADRs that look most interesting after the Archegos blow off. So as I mentioned, every week, typically one small mid cap, one large cap, and one thematic. And we make it a point to track the performance of these ideas very closely. Well, look, some of them are hard to track right now, like the Grab SPAC, because it hasn't even listed. But by and large, all of these are recorded, tabulated. So, December, when we kicked off the forum, there's been an average 25% return across both, positive and negative ideas, and so on. Of course, these ideas take a while to start kicking in. Smartkarma often tends to be quite early, such as the nature of independent research. So today on the forum, we're going to kick off with Del Monte, and I've got a and PSE there, which is a Philippine stock exchange. But I'm very, very grateful. We've got Nick van Broekhoven, who's actually dialing in from Antwerp in Belgium just for this. He actually landed there just a few hours ago, so I'm really grateful. He's sort of found time to join us. So, without further ado, Nick, I would like you to just run through the Del Monte specific part. I know you've got to run after that, and I'll take over on the Philippine Stock Exchange side. So we've put together just a few bullet points on the left-hand side, maybe to help.
Yeah, sure. Thanks for the invite. I'm happy about Del Monte. So I first wrote about the company on the 2nd of March on the Smartkarma platform. So the story here, we need back to 2013 when the company, so Del Monte Pacific, and that's also important to understand, the Del Monte brand has been around for a long time and has had many different iterations, but now we're talking about the Singapore listed Del Monte Pacific. Del Monte Pacific also has a dual listing in the Philippines, so there's two listed entities. And they, in October 2013, they bought the US business of Del Monte for $0.7 billion US, and took on a lot of debt. That did not turn out well. Share price basically depreciated from about 75 cents to about 10 cents last. Now, thanks to COVID last year, the US business started to recover substantially. Margins were going, people were eating more at home, restaurants were closed, so they were benefited substantially. They've been able to reduce their US debt. This has helped, to see some recovery in the share price of Del Monte Pacific. Now they also have a Philippines unit, which is basically the business in those, and that is now one of the catalysts described in the 2nd of March, and which is now then come to fruition, is one of the reasons why the stock's up 40% in the last month or two. Reason is that Del Monte Philippines will now list, this was just announced yesterday or the day before, at a valuation of around $2 billion US. So this is on the back of Nissin, which was the largest IPO ever, which will come to market at the end of May, and which is being led by bulge bracket sell-side firms like UBS, Citigroup, and JP Morgan, I think. So this basically, it is a very positive development for Del Monte. The reason is that the U.S. position in 2013 is slowly being built. But now, if they can list the Philippine unit that they control 88% of, this can really help them to reduce their gearing and shift more of the value to the equity. And this is what the market is to reflect. The second catalyst is the US entity they bought in 2013 and which have not performed well. It's now performing so well that there also is an option there to list that one separately as well, and basically have the Del Monte Pacific entity in Singapore as a holding company, which still have some stake in the Philippine business as well as American business. And this could unlock a lot of value for minority shareholders in the Singapore listed entity. And this is, where I think the opportunity is, then that is now being discovered. Recall there's no coverage here of Monte Pacific. The market gets just about to hit, $500 million US. But they have $1.6 billion debt. So with this listing in the Philippines and with this listing in the US, the hope is, some of the debt can be reduced either at the subsidiary level or at the holding level, and that this can shift the balance in favor of the equity holders. And I think that the thesis is starting to play out because these have now been announced, and also Moody's has upgraded the debt profile of Del Monte. So this should also put them in a position to refinance some of their outstanding bond issues, and probably at a more advantageous terms to the. I don't know if if there was anything that a major that I missed, or if you wanted something to talk more about.
Yeah. So maybe just to sort of recap. The main thing is that there is sort of a lot of intrinsic value in the Singapore listed entity, which has been, pushed down, right, because of the heavy gearing that the group has had. And what they're starting to do now is list out some of these privately owned vehicles and raise equity capital, pay down debt, and hence reward patient shareholders who've been around for a while. So that seems to be the basic thesis. As you mentioned, the first catalyst, which is a big one, is the IPO of the 88% owned Del Monte Philippines, which got announced yesterday. The filings came out yesterday. And as you mentioned, that's not going to be the end. Post that, there's likely going to be the listing of Del Monte US, which is also 94% owned. And it's an asset that they bought for $1.7 billion. So that seems to be the thesis. I think it's a really interesting thesis. One question which I'm getting asked is obviously, share price has gone up quite a lot already. Is this good news priced at? What sort of fair values do you think this could come to, and so forth?
Oh, I think there's a lot more upside to play, particularly, especially if they also list the US entity, because this is now basically a half a billion US dollar company, but combined, the course on if it's all vendor shares, or if it's the mechanics of the IPOs are just going to be come together, and I think that's will determine the amount of upside. I still think there's more upside to play for, and there could be a lot of upside if the debt is reduced significantly the next 12 to 18 months, and that could, I think, see the share price double from half a billion to billion or so market cap. Don't forget, there's no cover here. Of course, it will also depend how Monte does. It starts listing at the next month, and it's I think the risk reward is still favorable, even though you had the first 30-40% rally in the last 45 days.
Yeah. I think an important point that you're making here, Nick, is that Del Monte as a stock is really underowned, especially from institutions. Given what has transpired over the last 4 or 5 years, no one's really had an opportunity or a reason to be a major shareholder, and that might change very quickly into these cap raisings, which could be interesting.
Yeah, I think these cap raisings will also solicit a lot of interest from the banks who want to be involved in these raisings. So I would be not surprised if we see some coverage on the group or some subsidiaries relatively from maybe surprisingly large investment banks.
Yeah, and I think as we get more clarity on the size and shape of the Philippines listing, I know the 500 million number was a slightly old number. I heard take close to 700 million yesterday, but it's still not 100% confirmed. But I guess once we get confirmation on the size of these listings, it'll become easier for you to figure out how much more upside to go from here. But it still looks quite a long way.
Yeah, exactly. So once these details are released, once we get a prospectus, etc., and it will be much easier for everyone to see, how the real value is. But to me, I think risk still looks attractive here.
Now, another thing, for the attendees to note is that the Del Monte USA, because it has this big bond that's outstanding, and I think you noted in your research piece as well, Nick, they organize regular conference calls, and there's actually public filings that come out because of that bond. And you also noticed how the management there specifically noted that they're seeing great growth right now, strong double-digit growth, basically.
Yeah, exactly. Correct. And also their competitor in the US market is Seneca Foods, which is also a US listed company, and they all had very strong earnings, and they expect this trend to for healthier lifestyle to continue after the pandemic is over, because that of course is the risk. I mean, if let's say the US goes back to quote unquote normal, and F&B in-premise dining goes a lot, maybe then Del Monte will suffer, and that is the question, of course, to investors, if it's going to be the case, or if there's a permanent shift that really benefits Del Monte's cooking from home and buying healthy foods yourself instead of than eating out.
Got it. Well, and I'll just sort of take the viewers to the Del Monte page here on the platform. Stock was up 4%. Interestingly, the line in Philippines was up 19%. So I think the Singapore line has been moving a little bit slower than the local Philippines line, but I think you can sort of start to see where, close to about 20 cents, where Nick really started picking up coverage, and he's been reiterating since. But Nick, we look forward to more pieces on this as the situation emerges and more data points are revealed. But I know you're in Antwerp.
Yeah.
You've got a million things going on. So we'll let you run. Thank you so much. We're really grateful that you made this time.
Thank you.
Bye. Thank you. Well, that was Nick van Broekhoven. He's one of our independent research providers. He's typically based here in Singapore, but as you noticed, he's in Antwerp right now. Now, before I move on to the next section, I'll take maybe 30 seconds to talk about the Philippines Stock Exchange, because in a very clever way, it plays into this whole Philippines IPO story. So this is the monopoly stock exchange of Philippines. It's a listed company. The market cap is, just north of $200 million. I'll show you the chart. The stock price is really down and out. It's actually down about 50% from where it peaked several years ago. So let's look at the 5-year chart. We were at about 280 today. Today it closed at about 160. So it's down a lot. Meanwhile, it is a very, very big beneficiary of new IPOs. And they've not had big IPOs in Philippines for a few years, and that's completely changing this year. So you have Nissin Mond, which is the biggest noodle maker, listing right now as we speak. They're raising $1 billion, and it'll be the largest ever IPO that the Philippines has seen. Right after that, we will have Del Monte, which got finalized yesterday. We hear there are anywhere between 4 and 6 more REITs that are going to be in the pipeline, and a whole bunch of other smaller companies. So I think this year is going to probably be the strongest ever year for new IPOs in the Philippines market. Meanwhile, retail participation in the market has been surging. The company has a lot of cash. It's got very high dividend yield. The founder, who's very well regarded, is 80 years old this year. In fact, it was his birthday this month. So there is a potential succession or monetization of stake angle. It is extremely cheap as a stock, and there is reason to believe that other regional exchanges that are bigger would look to take a stake, maybe. So both from a cyclical perspective and a structural perspective, Philippine Stock Exchange is a very, very compelling way to sort of play in the long-term growth of the stock market in the Philippines, and also the flurry of new IPOs. And just to highlight to you, Angus McIntosh has initiated coverage. This was earlier this week. So I would definitely recommend you guys take a quick look at this. Personally, I am a very, very big fan of owning monopoly businesses, especially businesses like the PSE, which make incredible profit margins. I mean, just to show you, even with no new IPOs, this company makes about 76, 78% gross margin and nearly 50% net margin. That's in a bad year. Now imagine how things change when these IPOs come back and there's a lot of new market cap. Now with that, I will move on to the next topic today, which is a look at the private education sector in China and a lot of the listed companies there. And I'm really glad that we've got Osbert Tang joining us from Shanghai. Osbert, welcome to the forum. Osbert, you're on.
Hi,
there you go.
Thank you. Hi, thank you, Raj. Thank you, everybody. Have time to just spend some time on the forum to listen to me about the discussion on China's private education sector.
Thank you. So, Osbert, maybe just for new attendees who haven't seen you present before, just a very, very quick overview of your background. If you could just trace the arc of your career.
Yes, no problem. Well, I have been based in Shanghai for more than just roughly about 20 years. Spent most of the time on the sales side. Haven't been working with BNP, Paribas, ABN AMRO, RBS, and also take about 2 or 3 years spending of time in working for Moody's as a rating analyst, focusing very much on the rating for infrastructure sector companies. So basically have a very extensive experience in China, covering quite a lot of Asia as well. So this is briefly about my background. I've been on the Smartkarma platform, I think, since the middle of 2019, I believe.
Yeah, well, Osbert, I think I can say on behalf of everyone on Smartkarma, we've really, really enjoyed having you on. You bring a very useful and compelling perspective from on the ground in China. And earlier this year, you did a Smartkarma original, which is a deep dive into the private education sector in China. And today, we would love it if you can spend the next 5-10 minutes running us through some of the key points, and then also, your top 3 picks. And I'll help maneuver the slides for you, which I'm sharing at the moment.
Sure, no problem. Okay, thanks everybody. Over the next couple of minutes, actually, I will share first about some major developing trends for the China private educational sector. And then, as Raj said, we're going to talk about 3 topics that we have in this sector. First of all, we would like to talk about the trends. The first one is that we see an increase in willingness for the parents to spend on education. Actually, I would like to share with you one figure is that only normally around 1.1% of the population in China aged at about 18 are admitted to what we call as the 985 universities. These are the premium and well-known universities in China. You name it, something like Tsinghua, Peking University, and also, for example, like Jiao Tong and Fudan in Shanghai. And basically what it means is very difficult to get into these top tier universities. And as a result, what it means is that the more and more parents, actually like us, based in Shanghai, spending more money in investment in, for example, like taking the students into more training of additional different skills, and as a all-round person, that includes something like going to extracurricular class on art, music, coding, debate, and sport, something like that. So what we see is that actually the parents are spending more and more money on education for their children. And so that creates a significant demand for the private educational sector. The second driver is that apparently we're talking about that maybe it looks like it is negative. It's the decrease in the birth rate in China. In 2000, well, before 2016, China has been very much stick to a one-child policy, which starting 2016, it has been released to a 2-child policy. That resulted in a pop in overall birth rate in 2016 and 2017. But however, what we see is that the birth rate dropped back to relatively low level after this 2 years brief increase, because rearing a child is actually quite expensive in China. And so that is why we see is that I saw today actually a news report talking about that China's population actually is now possibly below 1.4 billion. It's not as widely discussed about 1.4 billion of population in China. And well, on the one side, it's actually we see that that is negative towards the total number of school-age children in the future. But at the same time, as this happens, we will see that we are, as the parents get more and more affluent, wealthy, they're actually increasingly willing to spend money on their single child. So what is that? Is that actually a 2 offsetting factors? So we see that you can see that that is a negative factor in terms of the total number of students, but at the same time, they're more willing to spend more money in other extracurricular activity, as well as education, as well as tutoring. The third factor that we want to share is that about 90% of the funding for the education in the local government was actually county or the local cities are actually coming from the local government, not from central government. And as you can see that the local government's own budget is relatively limited. And most of the local government are quite highly leveraged. At the same time, the money they have in terms of the funding, they need to spend on infrastructure and urban construction, etc., etc. So leaving that increasingly pressure on their financing for providing public education. What it means is that allowed a potential room for expansion of the private education sector. They would see that because of the constraint the local government's budget, there will be more reliance on private capital for education. Just share with you one figure. In fact, about 24% of the students in higher education in China are actually studying in private institutions. So you see that that is actually a quite significant demand coming from the private investment in the education sector. The fourth factor is that quite interesting. We see an increase in demand for civil servant examination training. It is interesting that the civil servant job in China is actually quite welcome by most a lot of university graduates because they have high job security, very clear promotion path, and also good benefits. At the same time, what it means is that on average we have a figure, including the central government actually applying for a governmental position in both the local government and central government level. That means a very significant market for those companies, which one of them is actually the A-share company Open, that is actually listed in Shenzhen, that is a specialist in terms of providing training for civil servants in China, civil servant examination in China. The fifth factor that we want to share is that the weak economy, actually you can see that China's economic growth has been slowing down. If you look at the more adjusted level while they're looking at the sharp pop on the back of the low base in last year, overall growth rate has been slowing down. The weak economy has actually led to more students because the government has encouraged more fresh graduate to continue study. For example, there will be something like 2 million in terms of the additional intake of higher education over 2020 and 2021. I think one interesting thing we can see is that, well, I remember when the overall, like the US economy is weak, we can see actually more and more students, example, the MBA class, MBA degree. So that is actually, while the economy is weak, we can see more and more students actually go back to schools, and so that created higher demand for the higher education. The sixth factor is that the acceptance towards the online education. Everybody knows that last year, because of the pandemic, a lot of offline education, face-to-face education actually shift to online, and that creates quite a significant number of new players on online education. And also, as the pandemic getting more and more under control, there are quite a lot of the OMO, that's online merge offline tutoring service, being offered in China. We have one figure is that in 2020, on average, we have 175 new online educational enterprise are actually being set up in China every day. 175. So you see that actually has support a significant growth in the overall online education sector in China. And lastly, an interesting trend is that there is a less preference for overseas studies. That means that, for example, a number of reasons, including the COVID-19 outbreak outside the Sino-US tension, which, as you can see, that only up to this week that the direct travel between China and US was actually resumed, and then visa office start to reopen for students applying for F1 visa to US. It's still going to be very much less attractive for local students going to pursue study in overseas. Especially, we can see that good economy in China actually retaining a lot of students to study in China rather than study outside of China, because that more and more local knowledge are actually needed for better, for example, business opportunity here in China. So as a result, more and more students actually prefer to study in China for higher education instead of going overseas. So what it means is that raised the local higher educational demand, while at the same time that would be negative for some international schools, which we name one of that is actually that has some kind of negative impact on like China Maple Leaf, which actually focusing more on the international school program for studying overseas. Next, we will move on to talk about the top 3 picks that we have in the sector. The first one is China Education Group. We like the company mostly because that it has the pure exposure to higher and vocational education sector in the country. Because of the focus on the higher educational sector, it has less regulatory risk because the regulation are more focused on the K9, that's actually meaning that for kindergarten to grade 9 or grade 12. Grade 9 is up to grade 9 is compulsory education. So the government actually has more strict regulatory oversight over the operation for private companies. And so it has pure focus on higher and vocational education. So it entails less regulatory risk. The company, meaning that the graduates are actually they have very good track record of executing M&A so far since the company was listed. It has completed more than 10 different merger and acquisitions of schools, and that also generate quite solid earnings growth already. They just announced a result I think 2 days ago, which they show that they are already having some 6 schools currently in their pipeline, which is almost quite close to a conclusion for potential acquisition. So that would also add to the company's earnings outlook when they are concluded. And lastly, we like the company's quality management in the sense that they are very experienced, and then they are quite involved in the policy setting in China's educational sector. And lastly, they are basically very motivated because all the major shareholders are actually shareholders in the company. The second company that we like is Tianli Education. Interestingly, this company is focused on K-12 schools. So one would ask why we like this school, because given that it is or have exposure to the K-9 levels, which are seeing more higher regulatory risk. Well, that is true, but we like the company mostly because that its K-12 schools are mostly in lower tier cities. And although they are having more regulatory uncertainty, but they are also balanced by government support. I mean, many of these lower tier cities, the government budget is actually much weaker, means that more and more need for reliance on private enterprises to provide education. In Tianli's case, they will enter into the local cities, normally tier 2 and tier 3 cities, and when they are able to be provided by some government subsidy of the operations of the school. So what actually is that they are actually working closely with the local government, and so that should be something protect them from a significant regulatory uncertainty. And at the same time, the lower tier city, we see growing affluence and generate more demand for the K-9 private education. One interesting thing is that they are actually having very good university admission records for their high school graduates. A lot of them actually goes into the 985 University, Peking University, Tsinghua University, and they have a very solid pipeline currently in their portfolio. So that means that they also see very good growth. China Yuhua used to be very much focusing on the K-9 education, but actually they have already shifted to higher education through acquisition of a number of local university and colleges, as well as one in Thailand. And overall, that helped the company to reduce the overall regulatory exposure. Now, if you look at the overall earnings breakdown, about 91% of the earnings actually coming from higher education, versus I think in 2018 probably it's only around 70%, around that level. So they are actually having a very good shift from focusing on more regulatory exposed K-9 education to higher education. and they have very good acquisition performance, and then they have actually prudent investment strategy. They have made quite a number of acquisitions last couple of years, and they have decided to slow down the pace a little bit for taking time to absorb and digest the acquisition that they made in the last couple of years, and which in the latest result for the company, which also announced I think 2 days ago, it has shown very remarkable cost control ability. So that means that it can actually improve the profitability of the school that they acquire, earnings growth rate, and that is the other reason that we like. These are the 3 topics, and the last thing we want to show you is the relative valuation. Particularly, I think the focus will be on the 3 companies: China Education, China Yuhua, and Candy Education. These 3, we can see that they have relatively good in terms of the earnings growth, talking about range between 30 to 40% on a 4-year basis. 4-year basis, we actually take it between 2019 to 2023, mostly to remove the distortion from the COVID-19 impacted 2020. And also for them, they have trading at relatively reasonable multiples against the sector level, which we think that that's why we like them most when compared with the other players in the sector. So a valuation against growth, they look more attractive when compared with the other peers. So that's what I want to share in terms of the presentation, and then I'll hand it back to Raj to see any questions that we may have in terms of the China private education sector. One last thing I want to highlight is that it is actually very good timing, because over the last education company has reported results about which company did show a better earnings growth and which company are weaker in terms of the earnings performance. Thank you.
Thank you very much, Osbert. I think you might be using some VPN to dial in today. We were losing you in patches, but it's great. I think we got the gist.
No, I think I did not use some VPN. Yeah.
So, you know, like for me, the thing about birth rates was very, very interesting, because this week, actually, FT leaked that the Chinese census might record a decline in population for the first time. And then I understand the census delayed the release of the population numbers for a little while as well. So I think there's going to be a lot of discussion and global focus on the complete sort of break in population growth that we're seeing in China. And I think, as you point out, weirdly, that's actually great for the higher education sector and the private education sector. So I think that for me is a very, very interesting point. I think the other point that I noticed is the earnings that are coming out from some of these companies, like China Education, are extremely strong. I mean, you wrote on 839, you know, this your top pick. You wrote up on their results yesterday, and I was looking at them as well. You know, everything has grown between 50 to 70%, whether it's top line, bottom line, dividends, and there is great pipeline of more acquisition opportunities for these companies. So, and I think China Education is worth talking about, because it's now a fairly liquid counter. You know, $4 to $5 billion market cap, trades over $10 million a day, and I think in the current environment, a lot of other sectors have huge uncertainty, but I think this name can potentially become a must-own for a lot of institutions. So definitely agree with you, one to focus on. Now I've got one question. It's coming in from the audience actually. They want to understand a little bit more about who regulates this space. Is there a specific body that regulates private education? And you know, how do you sort of compare today the sort of the best universities in China to, I guess, some of the Ivy Leagues or other top tier universities overseas?
Yeah, I think in terms of the regulatory authority, mostly the regulations are actually designed by, if you talk about mostly the policy, that would be very much relying on the regulation from the Ministry of Education, which set the policy for education in China. For example, in terms of the compulsory education, as well as the higher education in terms of the school approval. These are very much relying on the regulation from the Ministry of Education. But from the pure investment part, who can invest in what, for example, or who can invest in what school, that is actually a combination including the NDRC, as well as the state councils, for example. So that is actually one thing that we see that that would very much involve, for example, the Ministry of Commerce as well. So that is actually two areas. One is purely from the educational aspect, and the other one is actually on the investment aspect. Education aspect is more on Ministry of Education, and for the investment perspective, that would be very much relying on the regulation by the State Council as well as the NDRC, the National Development and Reform Commission.
Got it. Thank you, Osbert. Osbert, I know I'd only asked you to allocate 15 minutes. It's been more than that, so I'm going to let you run. Thank you so much for joining us. We're going to be following your work on the platform very closely on this space. Thank you so much.
Thank you, Rex. And so just let me know if you have or any clients have any questions. Thank you very much.
Understood. Bye-bye. Okay. So, you know, that was Osbert. You heard from him directly. I love Osbert's work, and it's super nice that we can sort of talk to him so easily and directly through Smartkarma and learn from him. Now, I'm going to take maybe just 2 more minutes, not longer than that, to go over the last thing today, which is the WeDoctor IPO. This is you know, a stock that hasn't even listed yet, but it's trending a lot on the platform, as you can see from the interest level chart here. So just a few key points. So, and please ignore my typos here. So this is China's largest digital medical services platform. They operate internet hospitals, that's the term that's colloquially used in China, and they also do digital consultations. So, you know, WeDoctor Hospitals has amazing strategic investors on its cap table already. You know, Tencent, Hill House, Morningside, Qiming, Sequoia, CIFH, they're already shareholders as a private company. WeDoctor is looking to raise $2 billion in its upcoming IPO. Now, as I mentioned, there are 3 big services. The first is digital consultation and diagnosis, right? And this happens through these internet hospitals. The second is they offer a subscription service for health management. And third is they also offer a digital chronic disease management service. Now, medical services is about 40% of the business, while maintenance services are 60%. And bulk of these maintenance services are the sort of contracts that they offer to corporate customers and its employees. So this is a 15 to 17-year-old business. Jerry Liao started it. He's quite a prominent founder. He's been very involved in China's tech scene as well. This is a really fast-growing company. Its total revenue grew about 170% year-on-year CAGR in the last 3 years, and that growth is accelerating. Also, the fee per consultation has also nearly doubled, which is amazing. So, you know, I guess that also reflects that they were doing a lot of discounting in the early years. But the average revenue per user has also grown remarkably. Like in 2018, it used to be just 35 RMB per MPU, which is paying user, and now it's 92 RMB. Now, the TAM, or the total addressable market here, is absolutely massive. And I think this is why global investors will be paying a lot of attention to this upcoming IPO, apart from some of the other points I mentioned. There's a lot of coverage on this company on the platform already. And as you would notice, this is one of our big strengths. We cover upcoming IPOs as well as private companies very, very closely. Now, just one last thing to point out. There are 3 other peers there is Alibaba Health, there is JD Health, and there is also Ping An Doctor. And actually, you know, our China-based healthcare analysts see JD Health as potentially their top pick in the space, although this IPO itself is likely going to be pretty hot. Now with that, over to you for questions. We do have some questions that have already come in. So the first question is on what brokers do we use for Philippines shares? This particular user has been trying to look for them on Philips Securities Poems platform. So actually, you know, the Philippines market, you cannot access it through the internet. You have to email in your order to your trading rep or call them. I would point you towards Maybank Kimeng, who are one of the strongest regional franchises here in Southeast Asia. So they offer Philippines access for sure. Poems does as well, but as I mentioned, you know, you have to email your order to your trading representative. But you know, this market, having looked at Philippines for the last 15 years, it has this sort of boom bust cycle, and clearly it's been having a very rough time for the last 3-4 years. And as it turns, it'll become extremely hot and interesting for everyone. So that was the question on Philippines. If there are any further questions, let me know. Otherwise, we've had a fairly long forum today, 45 minutes. We typically like to keep these short to 20 to 30 minutes. So you can always connect with us on the platform, ask questions, reach out if you want to see recordings of previous forums, but we are more than happy to get your feedback to make these sessions more valuable for everyone. With that, thanks very much, everyone, and hope to see you next week. Bye-bye.